joining us today. We appreciate it. Appreciate all of you who have an interest in the market beyond what we typically cover in a committee meeting. This should be extremely exciting as usual. Michael will regale us with some good stuff. Before I get started, some of you haven't met Michael. Most of you have had a chance, but we don't let him out of the bat cave very often. So for those of you who haven't, he's our Director of Investments, and he leads the investment due diligence, manager selection, and asset allocation processes for us. And his team are the ones that ensure that our clients are utilizing the best-in-class investments. We were able to convince Michael to coming over from Newport Beach probably 8 or 9 months ago. We figured that was a coup. We're pretty happy about that. He joined us from PIMCO, where he spent about 6 years with their institutional retirement plan.
I'm still waiting for that sunny and 70 every day. You probably do, but,
it was sunny and 70 twice between now and then, and I apologize for any snow that might have crept in. But anyway, so Michael, we're using the theme today, a vote of confidence. Tell us what that really means.
Yeah, Corby, and also if you have questions throughout the presentation, if you want to use the question or chat function, we'll try and answer those throughout, and also we'll have time at the end for questions as well. So in terms of a vote of confidence, first I think it's really, as investors, acknowledging that, and to some extent trying to get as comfortable as we can with the idea that there's a variety of situations around the world that are going to continually to influence the economy and influence the market, whether it's Middle East turmoil, oil prices, emerging markets, particularly China, and obviously both elections here that we're hearing about and elections abroad. And secondly, really recognizing and working to recognize both the pros and the cons. If you just read the headlines today that are in the newspapers, etc., it's very easy to become overly pessimistic. I think it's critical to assess and understand the risks, but and there are legitimate risks today, but it's equally important to really see some of the very positive influences that are happening in our economy right now. And I think that's sometimes overshadowed by the downside. And one of our goals on this call is to bring a little more balance to that conversation in discussing both the risks and the opportunities. And then finally, there's always going to be events we can't predict. And no one really knows whether the market will be up or down next week. But what we can do is really cast a vote of confidence in ourselves as investors, and that the long-term investment plan that we're following is going to continue to move us closer and closer to our financial goals and a successful retirement.
No, you bring up a good point, Michael. We see the most successful retirees are those that stay focused and saving as much as they can, but most importantly, they stick with their plan through the ups and downs, which is really tough for a lot of them because there's just something driving you to react to those short-term turmoil. So before we move to the details, are there any updates to our view on the economy or the market since the beginning of the year?
No major changes. Certainly over the last 2 quarters, the U.S. economy has grown at a little slower pace than we originally expected. In fact, in Q2 it was only 1.2%, when really most of the economists expected to grow to about double that. But there are some tailwinds in the economy that, again, we think over the next 6 months we should see around 2 to 2.5% growth in GDP. And also at the beginning of the year we talked about really stocks were priced to return mid-single digits. And year to date, if you look at returns so far, they're there. They're above 8%. That doesn't mean there's not more upside. It just means that when you're looking at the returns of equities, investors may want to damper their expectations a little bit going forward. Similarly with bonds, the 10-year Treasury has started the year off above 1.8%. It's now down around 1.5%. So bonds have also had a pretty good year, returning close to 6%. So again, looking forward, they've kind of reached where we're at. Again, there's certainly room to run, but just something that we want to be a little bit more cautious of our expectations for returns going forward.
Good, good. So let's dig in and start with our economy, the U.S. economy. Despite the unemployment rate falling from 10 to 5, quantitative easing and keeping interest rates low, and the recovery, the housing market has come back, it still doesn't feel like the U.S. economy is very strong. It feels like we're kind of meandering forward instead of running at full pace. Tell us why. Tell us where we stand today.
The way I would describe this recovery as it's been very lean and very long. It certainly has not been the type of recovery we saw coming out of the tech bubble in 2002, the slight recession we had then, where really it was a fat 5 years and we jumped up quite quickly as an economy. But what I will say is if we really look at the building blocks of GDP growth, there has been some structural changes there. And what this slide is showing is comparing the 10 years really before the crisis to the 10 years of the crisis and then afterwards. And if I draw your eyes to the far right, where we're looking at labor force, one of the components of potential GDP growth, this is really where some of the challenge has been. As baby boomers have started retiring over the last 5-6 years, certainly more of them are staying in the workforce than anticipated, but there are baby boomers leaving the workforce. Immigration materially slowed down during the crisis and has continued to slow down. So one way to grow GDP is just have more people working, and the slow growth that we're seeing now is likely to continue for some time. The second component, and really the more critical component, because this can really affect not only total GDP but GDP per capita, which is really a good measure of wealth, is productivity growth. And this has also slowed. During the crisis, anytime an employee has to switch jobs or really switch sectors or industry they work in, they find themselves performing new tasks. So they've got to retrain, retool. That takes time to come up to speed with that. And really over the last 7 years, it's kind of been a constant shift from some of the industries coming in favor and going out of favor, et cetera. Secondly, the most productive time in your career is somewhere between the ages of 40 and 60. So if you think about the two largest generations, you have still some of the baby boomers in that range, but a lot of them have started moving out. Almost half of them are now above 60. And the millennials have yet to really, the other largest generation, have really yet to come in that. They're still getting trained on the job and starting to learn some of the critical skills. So that's really, demographics have been one reason why productivity has slowed. But I'm very optimistic about this in the future. I think this doesn't get talked about enough. You do have the millennials really retooling to really carry into the jobs that have come out. And then when you look at technology, whether it's robotics, artificial intelligence, 3D printing, biotechnology, even big data, I think the future is extremely bright on that front. So that's really the production side. What can we produce as an economy? But then there's the spending side. There's the consumption side. And the largest part of GDP is really consumption. That's about 2/3. And going into the crisis, you could really see that consumers were spending a lot more on debt service. And the chart on the right on this slide really speaks to that, where at the peak, or right close to the peak, they were paying almost 13%, just over 13% of their income on debt service. Through the crisis, you had you had defaults, forced payoffs that really brought that ratio down. That's challenging, that's tough to work through, but at the end of the day, coming out of that, we're in a much better position as consumers to have a little bit more of our income to go out and spend. And then finally, really talking about the jobs created. This is another positive sign that we've seen over the last few years. The jobs created are really jobs of the future, and they're jobs here to stay. You'll notice on this chart it's showing millions of jobs created since February 2010. So it's not been in government. There's been some in mining and construction, but those are also very cyclical in nature. But really when you look at health services, leisure and hospitals, and really information services. Those are the key components, and there's been a lot of job creation in those sectors, and those are here to stay.
Well, we hear a lot of talk that the unemployment number of 4.9 isn't a real unemployment number, and there's certain demographics that continue to have high unemployment, and too many people, tons now, are working part-time, and for various reasons, and I don't want to get into the arguments and why, but what could we take away from those arguments that might affect us?
Yeah, so when there's really 6 ways to measure unemployment, and the official one is something called U3, and that's the 4.9% that you might hear in the paper on CNBC, etc. But when people refer to that's not the real unemployment number, they're typically referring to something called U6. And all this number does is take those that are unemployed plus those that are underemployed. So those that are working part-time, as you mentioned, Corby, and plus those workers that have stopped looking for work because they're discouraged. And this rate is closer to 10. It's 9.7. So it is much higher. And I certainly don't want to diminish the fact that technological changes, structural changes to the economy, they have adverse effects on companies, certainly families and individuals going through that. Those are very challenging times. It's challenging to retool and move. This is largely what we refer to as frictional unemployment. It's ever going to be present in the economy, and a growing, changing economy, which is a healthy thing. But from a pure number standpoint, there are more current job openings per job seeker today than there have been for over a decade. In fact, the last time there's been more job openings per job seeker was May of 2001. And that was really a year later. That was when a very good economic time for the U.S. happened. So some very good positive signs on the job front.
Cool. Well, that's good to hear. Let's go outside of the U.S. now. What about the rest of the world? What are we supposed to pay attention to there?
Yeah, I think the first thing to touch on is Brexit. Outside of the Olympics, which was great, by the way. I really enjoyed watching those. It's probably the most mentioned international event of this year. And just to recap, Brexit was when the United Kingdom voted to leave the European Union. Immediately after the vote, markets sold off for 3 days. Then actually once realization came into effect that, you know what, trade between the UK and the rest of Europe isn't going to go down, the market immediately rebounded and since has gone on to reach new highs. So, always be cautious of the headlines you hear, and I speak to this point because if someone actually looked at the data, and on this chart what we're showing is where the United Kingdom imports their goods from. So what countries are they buying their goods? You can actually see in the purple, which is representing Europe, it's the predominant player. And they import quite a bit from Germany, France, the Netherlands. And what this ultimately translates into is that the UK was buying over 50 billion more goods from Germany than Germany was buying from the UK. So it was, and you could go through the same, Netherlands, Italy, France, these are all about 15 billion more. So each of these countries would have been worse or will be worse off if they cut ties, trade ties to the UK than the UK would be to them. So once you realize that, yes, there's going to be some choppiness and some bumps, but it just took a little while for the market and investors to realize, you know what, trade's not going to stop. It's going to continue going on. I think the next thing to really talk about is because of events like Brexit, because the developed economies in Europe and some parts of Asia, such as Japan, are struggling, the U.S. really has been the return driver around the world. And if you look at this chart, you can see really since 2009, the S&P 500 index in dark blue has really provided investors with cumulative returns of over 120%, while Europe, the rest of the developed world, and even the emerging markets, which is emerging markets in the green, they still given investors positive returns, but it's been diminished, somewhere in that 20 to 40% range since then. If you only looked at the last few years, you could be tempted to say, well, you know what, the U.S. is the strongest economy. It's done well over the past few years. That's probably where I should go, and you may consider pulling back your international and emerging market exposure. I think this would be a mistake, especially looking forward, because what's happened is ultimately these returns create different levels of valuation. And this is what this chart is showing. It's looking at forward price-to-earning ratios. And you'll notice the dark blue line, the U.S., if you compare it to really 06 to 2012, you can see that the gap between the U.S. and especially emerging markets have grown. And so U.S. equities in relation to international equities and emerging market equities are expensive. I will point out at the beginning of the graph, you can see an extremely large gap between the U.S. and emerging markets. The reality here though is 1997 was really the first time emerging market investing was started becoming somewhat mainstream, and then 1995 to 2000 was the Asian crisis. So this was not a popular time to be investing in emerging markets, and they didn't have a lot of tech. And if you remember, the big growth driver, even despite the bubble, the tech bubble, was tech. So that's where investors were seeking growth rather than the emerging markets.
Yeah. Well, what about absolute valuations? When looking at the U.S. or Europe or emerging markets, are equities expensive right now? I know interest rates are historically low, but what about equities?
Yeah, it's a great question, and there are many, many ways to really value equities, and certainly interest rates near all-time lows have been a driver of higher equities, both here in the U.S. and worldwide. There's certain valuation methods that directly incorporate interest rates. And then we've just shown on the screen a forward PE ratio, but I also mentioned, I think one I particularly like is called the Shiller PE ratio, and it's taking the current market price and really dividing it by the average earnings over 10 years, and they adjust this for inflation, etc. But it's really trying to smooth out an economic cycle and look at really what's the 10-year history and where do we stand. So if you look at U.S. large caps, today that Shiller PE ratio is 26. Now the median is 16, so it's certainly higher essentially than on average, but the max is 44. And so again, there is some upside left, but we do need to recognize that historically it is a higher valuation and returns going forward will likely be diminished. If you go to U.S. small caps, which are going to have a higher PE, traditionally it's at 45. The median's 40, so a little bit above it, but the max there is 52. So again, some room to run, but we are approaching that max level. If you go outside the U.S. and you look at developed countries, non-North American developed countries, the Shiller PE ratio is 13. Its median is 22. So this is a case where you've got a reverse where the PE ratio is below the median. So this is a signal that international equities are cheaper, at least from historical measures, and similar with the emerging markets, its ratio is 11, where its median is 17. And the minimum for emerging market equities is 10. So we're right near the minimum there. So when I look out at the market, certainly there's volatility, there's more risk outside international and with emerging markets, but I think in terms of valuation, it's also one of the more attractive places to be. So really, as you look at what could unleash some of these low valuations and drive international markets higher, there's really four things to pay attention to. It's the response to Brexit. The vote's over, but really this is going to play out over the next 12 to 24 months when they negotiate the agreements. Look for a smooth exit for the UK. That will be a very good sign. Second, the US dollar. Over the last 2 years, it has just been strengthening. This actually hurts in terms of US investors in emerging markets and emerging market companies. A strong dollar actually hurts the returns to us. But hopefully that should stabilize, and anytime it's in a tight trading range, it helps companies plan and helps investors better understand their investments outside the U.S. Certainly China needs to deal with its debt problem. Corporate bankruptcy is expected to grow 20% this year. I believe they do have the capacity to work through it, but they're going to need to show that. And that China is a major driver, and it could be a cause of either growth and return outside the U.S. or not. And then finally, earnings need to resume in Europe and Japan. Earnings have been shrinking. Again, they've got some demographic challenges. They've had some economic challenges. But as soon as those start to turn around, I believe you'll see the valuations really unleashed.
Okay, so we've talked about what's important in the U.S. and the rest of the world. The next section we'll go into, we've titled Beyond the Hype. And these are things that the news outlets love to emphasize and grandize and spin, but as investors, we should probably take with a grain of salt. So the first comes to mind is the election, of course. It's looming large all year, but I'm frankly quite tired of hearing about it. But what can you tell us about how that can affect us?
Well, I think most of us are at least somewhat burnt out on the election, and we have a couple months to go there, 3 months to go. But I think it's going to be the #1 headline for the next few months. And I was on CNBC a couple days ago, and I saw an article that said something like, what Donald Trump, becoming president really means for the markets. Well, I kind of laugh and chuckle a little bit when I see those headlines because nobody really knows. And you're going to hear lots of speculation about what each presidency means for the economy and the markets. And really, to be honest, depending on where you choose to get your news will be a different spin. You're going to hear both sides. What I think is important, there's two keys I want to point to on the election. The first is typically a presidential year is a typical good year for the market. So what this chart is showing, the blue is showing what the markets have done so far this year. The black line is showing what, on average, the market has done on presidential years, in general presidential election years, thus year 4. And then the gray is showing what it's done without 2008. If you draw your eyes to the far right of the graph, you can kind of see right about that November time frame, that early November time frame, you can see a kind of a uptick in the chart.
Yeah.
And that's, for whatever reason, when there's a new president, regardless of who it is, the uncertainty has gone away. And markets like that, they don't have uncertainty. So typically it's a good year. Now I will say 2008 was an election year. Not such a good year for the market. So it's not
I vaguely remember that.
Yeah, it's not a rule by any means. But it is typically a good year. The other thing to mention, and this chart is taking each possible combination of president and Congress, so Senate and House, or a split, etc. And if you look at the numbers, the gain annual, you can see 7.2, 8.6, 10.4, 7, 2.4. Now there's not a lot of data, so statistically speaking, we need to be a little careful. In fact, you can look at the Republican president split Congress in the gray, -4.3. Well, if you take out the Great Depression, which again I don't think had that's just economics playing out. I don't think it really mattered who president was at that time. If you take that out, that number materially jumps up. So regardless of who's in the White House, which party is in the White House, or for Congress, or for that matter, it's really secondary to other major drivers for the economy, whether it's demographics, technology change, trade deals, things like that. So just keep, regardless of your political stance, just remember that and don't let that really shake out your long-term goals and game plan that you have. Another headline that continues to pop up, although not as much as it used to, although I expect it will may play a bigger role a little bit later, is that of oil. Make no mistake, oil does affect our economy, and it certainly affects my personal wallet. I enjoy low oil prices. But it's more of a transfer of wealth when oil prices change rather than a creation or destruction of wealth. And so what this chart is showing is if you look around the world, the countries in blue and purple are going to be those countries that when oil falls are negatively affected. Their economies are relatively largely based on oil. The countries in green, especially dark green, are positively affected by falling oil prices. So again, there's pros and cons, there's trade-offs, there's winners and losers, but net, it's more of a transfer. And you may have heard, well, since oil's low, I don't want to invest in emerging markets, et cetera, things like that. But if you look around the world, I mean, you can see one of the largest emerging market companies, second most populous country in the world, India, is really benefits from low oil prices. So again, when you hear the headlines, just realize that it's a transfer of wealth rather than a creation of wealth or destruction of wealth. And sometimes that's tough to work through. I think of North Dakota in the U.S. North Dakota and Texas are probably, even in the U.S., which benefits overall, there's going to be hit. So the housing markets there are probably taking a little hit right now. But if you look else, the housing market's doing well. So
yeah, we've got the same thing going on up in the basin. It's heavily affected.
Yeah, so just keep that in mind. The good news is that with the past few months of the increase in price of oil, it's really started to stabilize into a range, that $45 to $55 range, where you've seen positive price increases quarter over quarter, so year over year. And that does two things. One, when oil stabilizes, it allows better investment. In other words, the oil companies, et cetera, know I need to buy a new rig, I don't need to buy a new rig. It also is going to work through some of the high-yield bond market. Oil companies play almost 25% a role in the high-yield market. So if oil stabilizes, investors can get a better sense of, okay, which of these companies are probably going to survive and which of them aren't. And that should help smooth and ultimately lift markets as well. And then finally, if you think about just pure earnings and that some of those valuations we talked about earlier, oil, as the oil companies in, for instance, the S&P 500, they've been a drag on earnings. You can see from this chart really all of 2015. So that's been pulling the earnings of the overall economy down. But again, with the stabilization of oil, they should start making money. They've been able to have some time to adjust their operations, and hopefully those will be a contributor rather than a detractor going forward. And really the last we've heard area I want to discuss is interest rates. We've heard, quote unquote, talk of a bond bubble since really 2010. And every year it seems that bonds continue to perform for the most part. I think we do want to acknowledge that we are near historical lows, at least in this modern era, and returns on bonds are going to be lower. But the reality is it's A, they continue to play an important part in a diversified portfolio, and B, a downside is not that bad. So if you look at this chart here, so this shows on the top line a change in interest rates. One to the downside, so if interest rates fall, and then two to the upside if they rise. And then that 1.6 is essentially the coupon on the bond, the yield you're getting. So if interest rates don't change, if you're invested in 10-year Treasury, you're going to get about 1.6%. Now, if you look, if the Fed were to come and raise rates and interest rates went up by 50 basis points or 0.5%, during that year, you would only lose 1.2%. So this isn't an equity bond market that's going to collapse. Sure, you could see some negative returns, but they're going to be very small. And then the next year, yields are higher, so you actually should start making more money. So don't fear rising interest rates. They're likely to become a part of life at some point, but certainly don't let that scare you, and don't let the headlines influence your decisions. And then finally, you don't have to invest in only treasuries. There are other parts of the fixed income market that offer higher yields and more attractive returns. So what this chart is showing on the horizontal axis is duration, which is a measure of interest rate risk. So the higher the number, the higher the interest rate risk. And on the vertical axis is the yield. So if you look at Treasury, just above 6, pretty decent exposure to interest rates, but not offering higher, very high yield. But there are other areas, investment grade corporate, certainly emerging market debt, and at the top of the graph, high yield bonds. Now, there are other risks such as default risk that come along with these. But again, if you select a manager that knows how to operate through that, they can produce higher returns for you. I will also call your attention to one other red dot in the bottom right, the foreign. You can see even lower yields than Treasury. If you've heard about Japan or Germany having negative interest rates, I mean, this is unfathomable just 5 years ago. Negative interest rates, this is crazy. Those, as long as interest rates outside the U.S. stay low, like they are in Germany and Japan, this is going to keep the U.S. interest rates low. They may rise, but it shouldn't be very swiftly, because investors, corporations can say, well, I can invest in my own country's debt at negative interest rates, or I can go to a very strong country like the U.S. and invest and get 1.5 isn't great, but it's better than paying or 0. So that's likely to keep investors low, interest rates here low for a long time as well.
Good. It's also a good reminder that bonds still play an important role in portfolios. I think we've kind of segued away for a long time, and I think that's important to remind us. Finally, let's recap our strategy for investing. We've heard a lot about different risks and opportunities around the world, and it's important to factor this into your long-term strategy. Not trying to time the market or significantly deviate from that plan is so important. And the key to a most successful strategy is typically to appropriately diversify your assets and according to the goals that you need to meet. So as Michael mentioned, there can be times such as the last few years where it appears diversification isn't paying off. But ultimately, over time, diversification wins out. Just as it takes a lot of us single votes to win an election, it takes years and years of our contributing to our accounts and remaining in the markets to capture the gains and ultimately get us to a successful retirement. And that's what this is all about. That's what we're all about. I've got a couple of questions here. If any of you have more questions, please submit them. Here's one from Anonymous. How long until a market correction? That's a great question. I think we all feel it coming regardless of the election, but what's most likely to be the trigger that backs us off these market highs?
Yeah, that is a good, and I wish I had the exact answer, but you know, market corrections happen all the time, and in fact, a 10%, if you think about like a 10% pullback, that's actually very normal in any one year, and it can be healthy because what it does is kind of shake some of the questionable people out, and then once it stabilizes, you often see the markets go higher after that. If you really are thinking about what can be a significant and substantiated downturn, really 3 things come to mind that I would keep an eye on. I think the first one is China. If China is unable to really work through their debt problem, if their economy is unable to transition from what has been a very export-driven economy to more internally, similar to the U.S., we export, but a lot of it's internal and consumers really taking over. I think if that doesn't happen over the next couple, 2-3 years, that could be one of the drivers for a correction. The second one is trade wars. And this is probably out of the election, regardless of which candidate, the harsh rhetoric on trade wars in the U.S. From both candidates is a little concerning to me. Big proponent of trade. You know, if you got rid of all trade, we'd be, you know, substance farmers. I don't think anybody wants to go to that. And trade is typically good. There's bumps and bruises and things like that, but you know, that's happening here in the U.S. Similar UK. We talked about with that a little bit, how that trade works out, and as long as those can continue. If not, that could certainly be a large market correction. And then finally, this is the unknown unknowns. Nobody ever knows this, but a lot of terrorist attacks in Europe, certainly here in the U.S. as well. If that continues to spread and accelerate, I think you could see a lot of people get nervous in that way. That's so hard to, that's impossible to predict. No one knows. But that would probably be the third component to really watch out for.
Cool. Okay, we've got a couple more. Do you see any particular equity styles or sectors to be at higher risk for correction than others? That's a good question.
Yeah, that's a great question. If you look at really U.S. equities, and I've talked with large cap, mid cap, and small cap managers, and they all say theirs is the best. But if you look at surely just a strictly valuation standpoint, historically small caps are the highest valued right now. So people have paid a lot for that. Hopefully they're looking for the growth. Also, in a typical economic recession or sell-off, the small caps are hit the hardest. So you put those two together, in terms of U.S. equity, U.S. small caps are again, I wouldn't take them out of the portfolio, but there's something to be aware of. There's some risk there. I also think that utilities are a sector that could sell if interest rate rise. People typically go to utilities for safety. What they've done is they've rotated out of bonds and fixed income into utilities to try and get higher return. If interest rate rise, you're going to see them start to rotate right back. So that's probably the one sector that I keep an eye on that has really rallied and is trading at, again, just valuations of prices that we just haven't seen historically.
Right. They
just don't have growth. You don't think of utilities as a grower, but they're trading at multiples of a growth stock, which is kind of a little dangerous in my mind.
Interesting. Thanks for that question, Mark. Another one from John Campbell. Oh, this is political.
Do I get a pass on this one? What's the question here?
No, I like it. How much does our national debt affect other countries' confidence in the U.S. dollar? And then the secondary part of that is which candidate is most likely to do something about our national debt?
Oh, man. Well, I think I can safely address the first part of that question. Not yet. Our level of our debt is actually fairly a good distance below a lot of the other developed nations that you see in Europe, Japan. Japan's over 200% in their debt to GDP. So we still have a way to go. At some point it may, but you always have to ask yourself the question: where else is an investor going to go? They're not, where are they going to go? They're not going to, with situations in Europe, they're not going to really go to the euro. I don't foresee anyone going to China and start using the yuan as a global currency.
Right. There aren't a lot of good choices.
There's not. And so currently the debt isn't playing a factor in the confidence in the dollar. And in fact, in times of trouble, we've just seen people fly to the dollar. So maybe down the road, but you've got to have a replacement. And I just don't see a replacement out there for the U.S. dollar at this point.
Yeah.
So hopefully that addresses the first one. The second one, let me just put it this way. From what I've read of both economic plans, they both, as stated, would push our debt up. This is always tough, but one of them certainly more than the other one. But neither can. This is the thing about elections, right? All these promises. Neither candidate has really shown how they're going to pay for these things. They've flown some ideas out, but the numbers just don't add up when you really look at them. So I'm going to answer this as both candidates will push the national debt higher. Not a great answer. Doesn't excite me at all. But that's the reality as I look at the two economic plans today.
Wow, that was delicate.
Can we end on something optimistic here?
Oh, I have one more from Paul Kessler. How much protection do target date funds really offer me? Seems to me that if I pay attention to the market, that I can do better than target date funds in my 401k by simply finding areas that with most opportunity.
Yeah. Two things on target date funds first. One, they are very diversified. In fact, they can offer you exposure, they can offer participants exposure to sectors of the market that really aren't readily accessible in 401k. There's just some investments that aren't structured well to fit into a 401k that they can access. Two, they're always going to ensure that you are taking an age-appropriate risk. And if you look at the studies, if you compare those participants that do it on their own versus what they would have received if they'd been in either a target date fund or a managed account, they earn 3% less a year. 3% less a year. That's an incredible number.
Yeah. Wow.
And the reality is it's because they're not risk appropriately diversified, and so when bad times happen or et cetera, they switch out of equities into something very safe but at low returns, and they forget to switch back. And so ultimately, we would say that we see most participants, 85–90%, going with the target date funds. And again, I think the statistics show that on average, you do better that way as a participant. And we all have day jobs.
Right.
You know, I keep up with the market. That's what I do.
Oh,
but most people, that they don't have the time.
That seems to me the crux.
Yeah.
If you have a job, pay attention to it. Don't do this.
Yeah. They're not. Target dates aren't perfect solutions, but they're pretty good.
Yeah.
They're pretty good.
Good. Well, that's all the time we have, and we appreciate the questions, and certainly appreciate your joining us today, taking the time, and most importantly, we appreciate your partnership. We enjoy our relationships with all of you, and hope that we bring a little bit of value to your prospect of helping your employees retire with dignity. Thanks for your time today, and we'll talk to you soon.